So good, it's 5:32. We'll begin on this beautiful Wednesday evening. Thank you to the audience for joining in. Thank you, Ayush, and thank you, Ramesh, for joining in. So, ladies and gentlemen, I'm Sankalp from PMSIF World. I represent the business development team at PMSIF World. And as you would know, we are one of India's leading platforms for alternate investments. InvestSense webinar is a part of our initiative to help investors make informed choices, help investors understand different perspectives from fund managers, from people who actually put their money where their mouth is, to put it in a subtle way. And in that tradition, we've got two very special guests from White Oak. White Oak, as you know, is one of India's leading portfolio managers. They manage close to $5 billion in India-focused asset, founded by Mr. Prashant Khemka. And today we have Ramesh, Mantri, and Ayush, Ayush Abhijeet representing White Oak. Ramesh is Director Investments with White Oak. He has 17 years of experience across as an analyst across sectors. He had earlier founded Ashoka Capital Advisors that advised family offices on South Asia equities. He was a part of a two-member team for Alden Global Capital, a US-based hedge fund. Prior to which he was an analyst at CRISIL. Ramesh is a CFA charter holder and an MBA from FMH Delhi. Ayush is Associate Director Investments at White Oak. Prior to White Oak, he worked with Avendus Capital as an analyst, and before that, he was associated with Deutsche as an investment manager, and prior to that, with Credit Suisse. Ayush holds a BTech degree from IIT Delhi and a PGDM degree from IIM Ahmedabad. So we've got very pedigreed guests today, and the flow of the show will be Ramesh and Ayush will present on the topic today, which is how White Oak intends to deliver alpha by balancing growth and valuations at market highs. 17K is the number that we use there. So before I hand over the floor, as I was discussing the flow, Ramesh and Ayush will present their take on the markets, how they are valuing the markets, how they're evaluating investment decisions, and post which we will open the floor to Q&A. Please ask as many questions as you can, from Ayush and Ramesh. We'll try to answer most of them. So before I hand over the floor to you, Ramesh, let me just put to you an insightful, poll result that I ran. So I asked Nifty at 17,000. I am fearful or greedy. 92% said fearful. 82% say greedy. Let's try to hear more from you. What's White Oak's view? What are you guys thinking? And how should investors look at the market now? Over to you, Ramesh.
Thank you, Sankalp, and thank you, PMSAF World, for inviting us. And thank you the participants for attending this show today evening. To begin with, we can start the presentation.
Sure.
So, first, we'll talk today about delivering alpha, balancing growth and valuations at Nifty at 17,000. So first, a quick introduction on White Oak. White Oak, as Sankalp had introduced, is a 4-year-old investment management firm. Next slide is a 4-year-old investment management firm. That was founded by Prashant Khemka. Today manages over 40,000 crores in Indian equity assets, based on our best-in-class performance of the funds over the last 4 years. And 80% of the capital we manage is foreign money invested in India. So we are one of the largest FPIs investing into India. Now, moving on to the topic, which is how do we sustainably improve alpha generation? And that we believe has to have 4 tenets of improving sustainable alpha generation. First is focus on bottoms-up stock selection versus macro investing or market timing. Number 2 tenet is avoiding pitfalls of top-down sector bets, avoiding artificial constraints like concentrated portfolios or targeting an X portfolio churn. And the 4th tenet is a different take on valuations by focusing on economic cash flow centric valuations versus accounting profits. And we will expand on this. First, the key question emerges is, why is alpha important? And this is a study that was published by Wall Street Journal in 2019 that looked at the performance of all active managers in major markets. We have known for a long time that an average active manager in the developed markets, particularly US, tends to underperform their benchmarks. However, one market where average active manager outperforms the market is India, and that has remained consistent over the last 5 to 10 years. An average active manager outperforms the market by about 3% a year. If you're a top quartile manager, you tend to outperform 5 to 6%. A top decile manager outperforms the market 7 to 8%. And at White Oak, where our performance has been more than 10%, our track record is in the top 1 percentile of managers. So let me give a very interesting thought experiment here. Let's say at the previous slide, please. Let's say at the end of 2009, you had this perfect foresight to identify the best performing market in the world at the end of 2019 for the next decade. By the way, that market was US, and US market delivered slightly under 14% dollar compounded returns over the next decade. And you are smart enough to invest in an ETF and capture most of that returns. Another person chooses to invest in India, and over that period, India only delivered 6% dollar returns. However, that person invested in a top decile manager who generated alpha of 8%. So interestingly, one person invested in the best market, another person invested in the best performing manager in India when the Indian markets didn't do so well in the last decade. Yet returns are same. So that is why alpha is the most important thing that should matter when you look at the Indian market and when you look at managers in India, the ability to generate alpha. However, the next slide, everybody still is obsessed about the beta or how the markets will do, how the macro will do. And by the way, and we are showcasing this chart from the financial crisis of 2008, there's always been multiple things to worry about macro issues in the world. In 2008-9, it was the global financial crisis. Then it was Brexit. There was the taper tantrum at that point of time. Then 2013, the worst year in India, with the Indian domestic crisis. And then you had the commodity crash. And then you had number of geopolitical crises looking out. And of course, pandemic last year. And again, we are back to concerns about oil prices, commodity prices, taper tantrum. We're back to circle. So the thing is, people spend too much time focusing on macro when there is no ability for anyone to forecast macro. Things like even the US Fed Reserve often have changed their interest rate policy. If they can't understand what is the odds that I and you can get these things right. Just for example, recently the geopolitical event that happened in Afghanistan was not even predictable a month ago, but suddenly it has happened. So that's how macro works. Moving on to the next slide. 2020, it was a great year to learn a basic lesson about macro, that there is complete futility of predicting investment returns based on macroeconomic events and worries. Now, it was a great case study of last year. The first lesson about macro is the usual worries about macros, interest rates, currencies, commodities, GDP growth rate, what the US Fed Reserve will do, are always well discounted in stock prices. They hardly influence the future path of equity returns in markets. Number two, what really sometimes matters is the tail risk that event that happens in markets and economy, something like the pandemic that happened in 2020. And while event like pandemic was absolutely unpredictable, even if you could predict the pandemic, you couldn't have predicted how markets would behave. Remember the day the Indian markets bottomed in March 2020, we only had 770 cases. Today we have more than 33 million cases. And yet, Indian markets in 2020 have delivered good returns, and 21 till date has been stellar. In the middle of the horrible second wave, markets have done exceedingly well. So that is why it's very difficult to bring out the relationship between even tail risks and market events. And so finally, any investment decision based on macro consideration which does not take into account bottoms-up analysis, is fraught with high absolute and relative risk. And we take a lot of inspiration from this quote by Peter Lynch that far more money has been lost by investors preparing for corrections than by corrections itself. And let me give an example of how these macro things impact decision making. Another thing that why do people want to understand macro? Because they want to time the market. And again, 2020 proved that why market timing is absolutely futile. You know, when the markets fell 40% in March, clearly there were big reasons to worry, because unlike the global financial crisis in 2018, now even markets were closed, transport was closed, everything was shut. It looked like an end of the world scenario. There were stories that it would take 5 to 10 years to get a vaccine. So in that context, it was right to worry a lot. However, the pandemic has only got much worse since then. And the fact that we are now close to 5 million reported casualties, yet markets, not only in India, but globally have done well. So let's look at the fate of two investors during the pandemic. One is a bottoms-up investor who always stays invested in the market. So when pandemic happened, stayed invested, believing that whatever is known is already, anyway, we can't predict how economies and markets will behave because of this crisis, because nobody knows. So stayed through the crisis, and the portfolio has grown from 100 rupees to 133. Another investor who's always worried about the macro. When the pandemic happened, and the pandemic was a good reason for, when there's so much things to worry, to sell down half of your portfolio into cash. And then when July 20 market started moving up, you said, okay, this is liquidity rally. This is nothing to do with fundamentals. And finally, the investor starts investing back in November. Where are you? You're back to your 100 rupees. You've actually lost 25% of your portfolio if you had stayed invested in the market. So invariably, markets don't bottom when the economy starts recovering. Markets actually start rallying when the first hunch markets has, this is not a bottomless pit. And that is why market timing is futile. Next slide. Then the big question that emerges is Nifty at 17,000. The question to ask is, does it really matter? In a country where over longer term, nominal GDP and corporate earnings grow in low teens, it is usual that every large number of years, markets will constantly hit all-time highs. In the last 9 years, 8 out of 9 last 9 years, markets have hit an all-time high. If you have to just worry about all-time high markets, people would have got out of the market in 2013 and would have lost a tremendous opportunity to create value in the next 7 years. If you look at this 21 years in this century, 70% of the years markets have hit an all-time high. That is just the nature of markets. We did another interesting data analysis to look at what happens to market returns after market hits an all-time high for the first time in any year. The 1 year returns after that is 9%, and 2 years later is 24.4. So actually the 2 year returns is exactly the same returns you expect in the markets from long term. So just because the markets have hit all-time high has no value on how markets will do in the 1 or 2 years. And after that, anyway, long-term fundamentals matter. Again, the question now is, why have markets doing well? And the key reason is corporate earnings are doing well. Now, 2021, our GDP declined 7.5%. If you'd asked me at the start of the year what would happen to corporate earnings, I would have said corporate earnings would decline by high double digits. Yet, corporate earnings have grown by 14%. We have had weak earnings for a decade. And the year when India's GDP, India's economy was the worst ever in 74 years in our history, corporate earnings have grown by 40%. Corporate earnings have been consistently beating estimates for now 5 quarters. The consensus estimate now is that corporate earnings will grow 34% this year and 15% next year. Even if we achieve slightly less than these numbers, it would still be the strongest earnings growth since 2004. Compare our earnings growth to the emerging markets. Interestingly, despite the fact that China has much less adverse impact of the pandemic, Indian corporate earnings have done much better than China. Is actually one of the best in emerging markets. And finally, looking at the corporate balance sheet, in a very extremely economically stressed year, corporates have improved their balance sheet. So the key conclusion, if you want to take from here, is markets are doing well because corporates are doing well and their balance sheets are strong as we go in. Finally, so how do we at White Oak handle these macro factors? This all discussion is. First, we believe it's impossible to predict the market. Please note my emphasis on impossible. I'm not saying it's difficult. I'm just saying it's impossible to predict the market. So what are core beliefs about markets? First, markets are in aggregate are fairly valued at all times. There can be a lot of stocks which are overvalued or undervalued at any point of time, but aggregate markets are fairly valued. Number two, macro is a source of random risks rather than source of alpha for us. Number three is that we believe top-down bets are no different from tossing coins. You sometimes get them right, sometimes you get them wrong. So there's no value to be added. So how do we apply these beliefs into our portfolio construction? One, we always stay invested with a bottoms-up approach to investing in great businesses at the right price. We have a balanced portfolio construction at all times. We consciously avoid top-down misadventures like market timing, sector rotation. We also manage exposure to non-stock specific risk in our portfolio. Let's say if it bottoms up, we end up liking a lot of exporters. In the process, we accumulate risk to the large exposure to currency. Then at aggregate portfolio level, we try to manage this risk. And what are the results of this? First, the big benefit of this portfolio construction is it frees up the team's bandwidth to focus on stock selection rather than worry about macro. We are able to deliver consistent alpha both in up markets and down markets. And of course, our performance has been the top 1 percentile of India dedicated managers in the last 4 years. And our portfolio has been very robust to non-stock specific risk in the last 4 years. The other big factor that impacts a lot of people, another quasi way of investing in markets through macro, is investing in taking sector calls. As you can see in this chart, the best performing sector keeps changing every year. Often the sectors that are bottom in 1 year often end up at top. There's no way to predict which sector will do well in the 1 year or 2 year time frame. Often a lot of people, translate their macro opinions through sector bets. I think interest rates are coming down, so let's buy auto, home mortgages, real estate companies. I think inflation is going up, so let's buy FMCG or metals. I think, currency is going to decline, so let's buy IT and pharma. We believe these are again nothing but quasi macro bets. At White Oak, we don't take any top-down calls on the macro. We ensure that the entire valuation we do at a sector level is neutral. So the positive, the upsides and downsides in our portfolio at the sector level add up to zero. So that top-down, we don't indulge in top-down bets. Let me give an example how this kind of top-down thinking often goes wrong. One great example is IT services industry 3 years ago. And these are the stories that we have picked up from newspapers in India. People had called out the death of the IT industry. 90% of Indian engineers are useless. The industry will get disrupted because of artificial intelligence and cloud computing, machine learning, right? And because of that, a number of investors didn't invest in IT services. I've heard smart investors tell me, the long term, in a decades, the Indian IT industry will go to zero. Even if an industry has challenges, there will always be companies that are executing better and will grab market share. If you don't take these top-down bets, you are able to then identify these brilliant companies. And in the next slide, we demonstrate how we handle this issue in IT services. So first, the chart on the bottom left shows the period when the IT industry was underperforming the markets. The broad view was IT sector is dead. Our view was, let's focus on companies with strong execution capabilities. Lower top-down view was low P multiples exist for IT sector simply because they have poor deteriorating prospects. We said absolute valuations don't matter. We were looking at relative valuations on free cash flow metrics. Today, of course, the scene has completely changed. Today, the joke in IT is trespassers will get hired. Now, everybody believes Indian IT industry has huge potential. Our focus is we're still focused on companies with strong execution capabilities. People again making this argument is okay, P multiples of the IT industry are all-time high. But when we look at on our valuation on cash flow basis, cash flow metrics, the IT industry is still in line with the market. This is despite the fact that IT industry in India has historically delivered better growth prospects, better cash flow, and better governance than the rest of the market. And finally, bringing it all together, these macro elements is our focus on balanced portfolio. And we take a lot of inspiration from this quote from Said Kalman. We shall never forget that macro, we only have hunches. In the micro, we can develop justifiably deep convictions. So at White Oak, we design portfolios that they reduce exposure to single factor risk. For example, one single important factor in the market is the market cycle. When market is going up, pro-cyclical companies do well. When market is going down, counter-cyclical companies do. It is always difficult to predict where you are in the cycle, right? That is known only in hindsight. So at White Oak, we always have a good balance in our portfolio between pro-cyclical companies from financial sector, industrials, materials, real estate, and then counter-cyclical sectors like consumer, pharma, IT. And because of this balanced portfolio approach, we not only outperform the market across the cycle, but every point in the market cycle, whether the market is going up or going down, we constantly outperform the market. Now, my colleague Ayush would talk about the two other key tenets of our philosophy. Over to you, Ayush.
Thank you, Ramesh, and good evening, everyone. So, moving on to the third important tenet of our investment philosophy, which is not to worry about or not to have any constraints around portfolio construction. Our goal is to outperform the best performing fund in the peer group, and to that end, having this unconstrained approach allows us to maximize the alpha potential that the Indian market presents. So, three commonly used constraints that people impose on themselves, fund managers impose on themselves, are number one, a preference for concentrated portfolios as opposed to having an unconstrained diversified portfolio. The second tends to be this obsession about having low portfolio churn as opposed to churn being an outcome of your alpha optimizing decisions. And third, having this dogmatic belief around buy and hold forever. And we think that all of these three, investing is anyway a very competitive field, and constraining oneself with these artificially constraints rather reduces the alpha generation opportunity as opposed to enhancing. And I'll explain why. The first underlying principle here is that, and this is a very underappreciated fact of the Indian market, is that India stock market is actually very heterogeneous and presents a very rich and diverse corporate mix. And let me explain what it means. India has about 5,000 listed stocks, at one of the highest, if not the highest, in terms of the breadth of the market. Out of these 5,000 stocks, there are 1,800 actively traded stocks, out of which 850 are actually more than a market cap of 1,000 crores, and in a way represents the investment opportunity for majority of the portfolio managers. Not only is the width of the market quite good, but also the depth in terms of the richness of corporates and industries and sectors that are present in the market is unparalleled in India compared to any other emerging market. For instance, if you think of Brazil or Russia or South Africa, all of these emerging markets are dominated by commodity-linked industries. If you think of something like Taiwan, that is dominated by semiconductors, and ancillary industries, whereas in India you have a diverse set of industries ranging from from financials to information technology to consumer staples, discretionary, healthcare. So there's a wide opportunity of companies that are available for investing, and that in itself means that you can actually generate more alpha by having more number of stocks in your portfolio. And let me explain it using a quick example. So if you look at the bottom half of the screen, the center column, any reputable manager today in the country is managing, let's say, close to 15,000 crores or more. And if you have a constraint of having a 15 stock only concentrated portfolio and assume equal weight portfolio, the average position size that you have in a stock is 1,000 crores. Now, to be able to build a 1,000 crore position size, and assuming that you don't want to go more than 6-7% of the outstanding equity of the company, you're actually only limiting yourself to the top 250 stocks in the market. Right? Remember, there were 850 stocks, more than a market cap of 1,000 crores. So you've actually missed out on several hundred companies where there could be strong alpha opportunities. And on the other hand, let's say if you have a unconstrained diversified portfolio where you're free to invest in 50, 60 companies, your average position size comes down, and therefore the addressable opportunity increases substantially. In fact, if you look at the opportunity funnel, the mid cap and small cap segment tends to be very inefficient. So India in general is inefficient compared to other markets, and within Indian market, the mid cap and small cap segment presents an under-researched opportunity where managers like us can actually hunt for a lot of alpha opportunities. And this unconstrained approach can allow for picking these attractive companies within the small and mid cap segment, which is the tail of within the top 850 companies. In fact, even having a small position, let's say a 1% position, which many frown upon, a 1% position in a small cap, mid cap company that can grow 4-fold, 5-fold can actually add a lot of alpha to the portfolio. And we have seen this play out across multiple examples in our portfolio over the years. Another important aspect of this entire debate of diversified versus concentrated portfolio is discerning the luck versus skill factor. The popular belief is that concentrated portfolios help to increase performance. There is absolutely no evidence, no studies, no scientific research that supports such assertions. In fact, to the contrary, there is now research that has come about which says that increasing the concentration in the portfolio actually increases the role of chance or luck, right? And having a diversified portfolio actually increases the role of skill in stock picking. And I would recommend the Vanguard's research paper on this. If you're keen to read more about it, it's called How to Increase the Odds of Owning the Few Stocks That Drive Returns, which talks about this entire study. What we've done here is actually taken a more simplified example of using a coin toss, which is a purely 50-50 event, to exemplify, to illustrate how the role of luck actually declines with more number of observations or more number of events. So here what you see on the screen is essentially a thought experiment where you do 10 coin tosses, let's say, and success is measured as having 6 heads or a 60% chance of getting hits on your 10 tosses. So if you only do 10 tosses, there is a 20% chance that you will actually hit 6 heads, right? Despite having 50-50 odds at the beginning. But if you keep increasing the number of tosses, right, the likelihood of generating 60% success goes down substantially. So if you see from at 10 tosses, there was a 20% luck element, which goes down to 3-4% as you go to 40, 50, 60 observations, right? And the same analogy can even be extended to concentrated portfolios and diversified portfolios, that as diversification increases, the role of skill substantially goes up and the role of chance substantially goes down. Moving on to the fourth key tenet of our sort of approach towards maximizing sustainable alpha generation is to think about valuations. And this has 2 dimensions. One is that all valuations, right? No valuation is absolute. All valuations are relative. All valuations are relative to the ultimate benchmark, which is the US 10-year, 30-year long bond rate, right? The important thing to to understand here is that valuation is relative to a frame of reference, and that frame of reference itself is constantly shifting, right? And if we agree that the 10-year US bond is the ultimate, frame of reference, and all valuations globally for every asset class is relative to what you see in the US 10-year long bond rate, what you see on the screen is the light blue line represents the 10-year interest rate on the bonds in the US. So if you notice that it peaked in the 1980s. In 1980s, the interest rate was close to 14%, which meant that the multiple, if you were to invert that 1 upon 14, so roughly 7 times multiple on the bonds. Now, this has come down to below 2%, right? So roughly 50 times multiple. So for the bonds, the multiples have expanded from 7 times to 50 times, right? Now, since all valuations are relative, we are not suggesting that even equity multiples should expand sevenfold from 7x to 50x, just like the bond multiples have expanded. But this is an important context to keep in mind whenever we are thinking about today's multiples. Comparing it with the multiples of 10 years ago average or 20 years ago average is meaningless, because the frame of reference itself has undergone a complete metamorphosis. And we can discuss some other day as to what the reasons behind why we have seen a 40-year structural decline in interest rate because of a structural decline in inflation expectations led by the unprecedented increase in technology and the impact it has on wage inflation, and then the cap on commodity inflation because of the advent of shale gas, electric vehicles, so on and so forth, right? But the broader message here is that all valuations are relative. And the second aspect is that instead of looking at accounting multiples, it is important to look at cash flow centric multiples, right? Because the value of any business is the present value of future cash flows. It is not the present value of earnings, right? And therefore, metrics like price to earnings or EV/EBITDA are at best lazy and crude shortcuts, right? They're not there. You can call them pricing, right? But not valuation. If you use them for valuation, these can actually be very distorted and misleading and even very harmful for investment decision making, right? Any such multiples that you use should be an outcome of valuation and not valuation in itself, because valuation actually entails a very thoughtful build out of cash flows. It entails a subjective exercise of assessing the terminal multiple that you should ascribe to the business based on the greatness of the business and so on and so forth. And this is a first principles approach that you should use to assess valuation. And with that, let me quickly walk you through the framework through which we apply this cash flow centric valuation approach. At the heart of this is breaking down the value of any company into two components: one which is a function of the invested capital in the business on the left hand side, and the other on the right hand side, which is a function of the excess returns on invested capital, right? Returns over and above the cost of capital in the business. And the left hand side, Finco, is actually a low multiple business. You can think of it as dumb capital that has been parked in the company, and the right hand side actually represents a very valuable stream of cash flows and is in a sense a quantification of excess ROIC or excess return on capital employed in the business, right? So now, instead of looking at price to earnings multiple, what we look at is the price to excess ROIC, excess return on invested capital, cash flow multiple. And to illustrate how PE multiples can be very misleading, let me take a quick example from the tire industry in India. And without naming these companies, let's call them Company A and Company B. Company A has a track record of having suboptimal capital allocation and inferior return on invested capital. And this capital, Company A, trades at 12 to 13 times PE multiple, right? 12 to 13 times. And Company B actually has far superior return on capital and trades at about 26, 27 times PE multiple. And the popular refrain in the market is that Company B actually trades at twice that of Company A, right? And therefore very expensive. When we run this analysis, what we find out is that for Company A, the poor allocator of capital, bulk of the value, 90% of the value resides in Finco, left-hand side, the dumb capital, and only 10% resides in right-hand side, the really valuable part of the business, right? And which means that for every dollar that they put in the business, they actually extract less than 10 cents or less than 10 paisa of excess returns. In sharp contrast, for Company B, only 15% resides in Finco, the term capital, left-hand side, and 85% resides on OpCo, right? Which means that for every dollar that they invest in the company, they actually extract $6 of excess returns, right? 6 times the excess returns. And therefore, this price to cash flow multiple that we calculate for these companies, while for company A, the P multiple was 12, 13 times, the cash flow multiple is more than 100. And for company B, while the P multiple was 26, 27 times, the cash flow multiple is actually 35 times. So this is how it looked on a P multiple basis, and this is how it looks on a excess ROIC cash flow multiple basis. And this is a very good illustration of how P multiples can be very misleading and can actually be valuation traps as opposed to a reflection of value in the business. And as they say, the proof of the pudding is in the eating. So far we have discussed all of the 4 key tenets that we believe can help to optimize alpha generation, maximize alpha generation. And this is the result of having applied these investing tenets to our portfolio. What this represents is quarterly alpha or quarterly outperformance in various market environments. On the left-hand side is how is the portfolio done in up markets, right-hand side, how is the portfolio done in down markets. What you would notice very interestingly
I think Ayush got disconnected. Just let us.
Yeah. I'll just complete it.
Sure.
So,
he's back in the room. Yeah.
So, as you can see on the left side, we have outperformed in up markets 75% of the time, and down markets we have outperformed 80% of the time. And the quarterly average alpha is 270, which is like 10% a year alpha on a cumulative basis. So this kind of demonstrates what we have talked about, the 4 key tenets of the investment philosophy has translated into strong and consistent alpha, the 2 attributes that investors like. We will stop here now and open the floor for questions.
Right. Okay. So I'll just stop the slide presentation for a while and while we take questions. So let me add to that, investors. So at PMS World, we have developed this proprietary model for analyzing PMS is called QRC, Quality Risk and Analysis. Okay, as a part of which we try to, like you said, any valuation or any alpha is always relative, Ramesh. What we have done is we have tried to find out the category alpha. Okay, we call it the relative alpha. So what it essentially means is how much the portfolio has done above the category alpha. So for White Oak's flagship portfolio, the India Pioneer Equity portfolio, the multi-cap category has yielded an alpha of 3.5% on an average, and the portfolio of White Oak has yielded a relative alpha of 2.04% over the average alpha. So that is the kind of performance White Oak has done. For the audience's benefit today, I discussed this. You can check out the QRC model on our website pmsifworld.com to find out more. Okay, so with that we will take questions. So thank you, Ramesh, thank you, Ayush, for your presentation. So we've got a lot of questions coming in. Okay, so the first question that I will probably take is from Mr. Sajjan Shah. Okay, he says, this is again with proper disclaimers and proper regulatory guidelines. He asks, can you suggest 3 sectors and few stocks? He says 5, but let's take a couple of stock example to explain your philosophy. Okay, what you talked about Finco and Opco, so that we can, up to you how you want to take this. Maybe if your actual examples of businesses will help to explain probably what you were explaining and what sectors are you looking at right now. Okay, before we get into that, let me just discuss with you the results from a few polls that I ran while the presentation was on. Okay, so here we are. So the choice, I asked the choice of portfolio, concentration or diversification. So concentrated meaning 10 to 15 stocks. 16% of the audience say that they prefer that. Somewhere midway, 20 to 30 stocks. 41% of the audience prefers that. And diversified, 30 plus stocks. 41% of the audience prefers that again. Macro factors, 46% of the audience feels that they are a source of risk, and an equal amount feels that they are a source of return. So that's what the audience feels, and with respect to what we discussed today. So over to you. The question was, can you take a couple of sectors or a couple of stocks to explain what you said about your philosophy and how they cover the four bases of your investments. So over to you.
Sure. So, for example, let's look at IT services, right? Because the comment is that they're trading at all-time highs. Now, when you look at the capital, when you look at the asset light framework, basically it ascribes a different value to invested capital and different value to the excess returns generated in the business, right? In IT services, the capital deployed is very minimal, and in fact is reducing further as the requirement for office space comes down in IT services, right? And in the fact that rental spaces are available. So it's a business as an industry. IT services in India is extremely capital efficient. And so large portion of the value, 90% plus value of the IT services companies lie in the OpCo,
Right.
right? So often when people make this error, like the Indian market currently trades on the OpCo multiple about 40 times currently. So when you do this analysis, while on P multiples it looks like some IT stocks are more expensive than the market. When you compare them on the asset light on the OpCo multiple, a lot of stocks are in line with the market, and a few of them are actually a discount to the market. So that way, we believe, and of course, consistently, the IT services industry has delivered strong growth relative to the market. They have some of the highest corporate governance standards that the industry has delivered across all, and of course, great balance sheets, right? So we believe that this bottoms up, we are able to find attractive opportunities in the IT services industry now, and there are companies which are there are a number of companies which are now able to grow close to 20% now in India in dollar terms in the current environment. So we continue to find a number of attractive opportunities in the sector. I won't name specific stocks. Then another sector again which looks expensive on traditional methods of doing business, valuation, is, let's say, some of the best CPG companies. I'm giving example of, let's say, HUL, Nestle, these kind of companies. These kind of companies, they actually deploy zero capital, because they run negative working capital in the business. So even the fixed assets are financed by negative working capital. So 100% of the value in these companies reside in the OpCo. So the entire valuation of the market, their P multiple translates into actually what you call OpCo Finco multiple. In fact, HUL actually runs on negative capital business, right? So when people make this error of trying to look at these companies on P multiples, I'll just give example. 3 years back, when we were looking at one of the large CPG companies, the company, one of the top CPG companies, right? The market was trading at 40 times, and this company was trading at 45 times. On traditional P and multiple, you'll say it's 125% premium to the market. It's expensive. But on the OpCo Finco framework, it's like only 25% premium to the market. And it's like getting a Mercedes at 25% premium to a Fiat. It's a no-brainer, right? So just giving example, even in sectors which seem to be well understood, often the valuation angle is can be different. The lens to look at valuations can be different and can lead to different conclusions.
Right. So Ayush, anything to add to that, or should we move to the next question?
Yeah, let's move to the next question, please.
Okay, so I'm going to ask the next question in a little bit different manner. So I think Mr. Rangaswamy has quoted many multiple famous investors who have had concentrated portfolios. So the way I'm going to put it is, okay, there's a difference between proprietary money management and public money management. You are in the business of public money management. Okay, so while there might be merits of either side, as a public money manager, let's put it out in the open. Why do you choose to have a diversified portfolio? I know you've covered it, in much detail in your presentation also, but let's look at it in a very explicit way. Okay, let's just answer the question most investors often have, and concentrated portfolios have been in buzz, and rightly so. So let's just look at it this way: as public money managers, why do you prefer a more diversified portfolio to a concentrated portfolio?
So we believe this idea of concentrated portfolios is a marketing gimmick. There is research now proven that and we have showcased the research in the presentation, right? That concentrated portfolios are subject to more luck, right? Versus our diversified portfolios are subject to more skill. Number two, we believe in a market like India, which provides this huge heterogeneity of companies across sectors, large number of small caps and mid caps. You as an investor, even if you invest 1% position in a stock and the stock goes up 5-6 times, right, you can create a lot of value. So we have in our portfolios a number of positions which in the last 4 years we've invested at 1% positions, and they have been multi-baggers, and they've some of them added 5-6% return to the entire portfolio. So just having 1% that can add up 5-6% cumulatively over time adds to a lot of alpha. So we believe that just the ability of opportunity the Indian market provides, even small positions can add up a lot of alpha. And by the way, the small cap, mid cap space that Ayush had talked about tends to be less competitive than large caps. The question to ask is, if you want to play a sport, if you want to win the game, would you want to play against a champion or play against an amateur, right? So small cap, mid cap is a more fertile ground for us to generate alpha. And in the last 4 years, we would be among the top 1 percentile alpha generators in small cap and mid cap. Number two, some of the other firms, of course, they tend to have smaller investment teams. So they cannot deploy the kind of research resources to research small cap and mid cap companies, where, remember, the brokers don't cover it. There is not much information available in the public domain. So actually, you have to spend a lot of research effort in a smaller company versus a large company. And so a lot of firms don't have that kind of investment in research. So for White Oak, in the last 4 years, it has done exceptionally well, this strategy of diversified portfolios.
Right. So point well taken. Okay, since you have a team, why not actually use it to research more companies? So I've got a very interesting question from Kalyan Reddy. He asked, what are the similarity between 2003 to 7 and now? So I'll just put it in a different way. Okay, what are you doing differently? Having that vintage, having that hindsight, or having that experience now, learned those lessons from between 2003 to 7 bull run. How are you looking at things in this bull run, and what are you kind of hoping to avoid, and what are you including in your portfolio? Comparing these two bull runs.
See, it's easier to make these analogies that you should go and compare the world to a different point in the world. But the Indian economy and the world economy has evolved a lot since 2003. Right. So, you didn't have a single mall in the whole country in 2003. And now we have hundreds of malls. India is a very different scale of economy, right? At the same time, the big stories, in those years, we were building infrastructure, roads, right? Basic stuff we were doing. Today, we are building world-class IT company, technology, consumer tech companies. So the economy has evolved. The sources of value creation have changed in the economy. The dynamics of the economy have changed. At the time, there are, of course, corporate today, we had before 2003, there was a large NPL cycle. In India also, in this cycle, there was a large NPL cycle. Interest rates were low then. Interest rates are low today. Commodities started flaring up in 2003. It's done that. But we don't know, because this is a lot of these things, Sankalp, it's much easier to say in hindsight than to say today, right? But the mix of companies and the kind of entrepreneurs that are coming today are very different. Today, you have first generation people coming out of colleges, building great companies, which they are taking public. In the previous cycle, you had companies which are coming from existing families or of course, in certain regulated sectors and all, right? So there's a very difference in the evolution of the economy.
Right, and that leads me to my next question. So what we have observed, that in the last couple dozen IPOs, most of these companies are younger than me. Okay, that is they were started after I was born, and I think I'm not too old. So there is a whole deluge of new age companies coming to the market. They're seeking fancy valuations. The promoter holding in these companies is often not too much. like to say what Aditya Puri did into 94, and it took him 25-30 years to build those valuations. A lot of the younger companies are doing it in 5 years, 10 years, 4 years. And if you look at the companies going to file IPO drafts with the regulator, are all new companies, new businesses, tech driven. So what is, are you going to be a buyer in any of these companies, when they go public? And if you are, or if you aren't, what are you going to look at? How are you going to evaluate these companies in your method of Finco, Opco, and how will you make that decision?
Ayush, you want to take this question?
Question. Very right about the kind of companies that we are seeing. A lot of them are from the consumer internet, tech-enabled sectors, and the way to look at them does not change, right? At the heart of any valuation framework is the idea that the present value of future cash flows is the value of the business. It may just happen that for some of these companies, and I don't want to paint every new age company with the same brush, because they come from very heterogeneous business models. Some of them are quite good, some of them not so good. Some of them are absolutely broken business models. So very important to break that down. But within the companies that are actually doing well, the way to think about them is that many of these new age companies are actually investing in customer acquisition. They are investing in building a superior customer experience, right? These companies don't need to invest in physical assets, right? And your traditional accounting methods actually do not consider investments in customer acquisition, a happy customer base, good brand assets, right? And therefore, and in fact, a lot of these companies are actually doing the right thing by investing significantly in customer acquisition, investing significantly in building a superior customer experience. They've cracked the right unit economics, because it makes sense to supercharge this loop. Because in India, we're at the early stages of internet evolution, right? And the availability of capital is there, and therefore it makes sense to supercharge many of these positive feedback loops. And at the same time, there are also several companies that have not cracked the right economics and who still might be pumping money and burning dollars, right? And without creating any long-term value. So as investors, we spend a lot of time actually thinking about these things and distinguishing between these two types of companies: the ones that have the right unit economics, that are serving large growing markets, that have a long runway to grow, that are run by credible management teams, and where accounting loss is just a matter of 1, 2, 3, 4, 5, whatever number of years. And it is a matter of choice. They're choosing to be loss-making right now because they're investing significantly to build competitive advantages around their business. And at the same time, there is a whole lot of weak, broken business models that are also doing the same thing. And investors should be cautioned to distinguish between the two, not paint every loss-making company with the same brush, as we don't paint every profit-making company today with the same brush, right? Many companies today that are profit-making may not exist 10, 20 years out.
Right.
We have seen that for the last 20, 30, 40 years. Right? So that is the perspective with which we view many of these new age consumer tech companies.
Right. Thank you. I think that was a very detailed answer, Pankit. That was Mr. Pankit Shah. That was answer to your question. Okay, so a lot of times, like you said, marketing gimmick. I am going to borrow something from that. It is much more behavioral in the market than anything else. Okay, we tend to fall to investing or activity in the market. A lot of time it feels that if we haven't done some activity, we are not keeping up with the market. So what is it that you think as investors, okay, should do at behaviorally should do at the market high? Okay, we have had a lot of talks about how investors should probably add more, stay invested during the market corrections, okay, try to average. But what do you think will be an appropriate, or will contribute the most to the portfolios of investors if they in what way, if they behave in that particular way, according to you?
So I think, Sankalp, I think every investor should think about what is their strategic, asset allocation, right? What is the exposure of equity they are comfortable considering their specific financial circumstances and the risk appetite. And the right approach is to stay invested according to your financial plan,
Right.
not go overboard, right? Which can, just like any prudence, not go overboard with risk. At the same time, for example, markets also were all-time high in 2003, right? But then they were extraordinary 3 years ahead of you. So markets are not predictable on the short term. If you're worried about all-time high markets, you should have worried in 2013 also and missed the entire market rally after that. So that's why stay invested according to your asset allocation. There's no, it's, I would say that is the most appropriate plan for every investor.
Right. So sticking to plan. So that's answer to all investors who are asking what to do at 17,000 Nifty and 60,000 Sensex. We've got a couple of questions on. Okay, it's the same two people asking about your NFO on mutual fund platform. Up to you if you want to answer that. Okay, the last question that we will end with is it's a very interesting question again, and this question was asked earlier in the session. That's why I missed it again from Mr. Rangaswamy. A lot of, I mean, what happens is, and this is again study done by one of your peer fund managers, that corporate profits in India are very concentrated. Okay, 80% of the corporate profit comes from handful of companies in the country. So in that essence, most fund managers, most money managers have those in some proportion in the portfolio essentially. Okay, so what is it that generates that alpha at White Oak above the category? Okay, I mean, what is it that you do differently? To take names, Asian Paints, Nestle, these are some companies that most fund managers would have in their portfolio. HDFC Bank, Bajaj Finance, and I'm sure you would also have them in certain proportions. Beyond this, how do you look at the market, the broader market, since you have a larger research team, and how do you in general use that to your advantage? And also the mutual fund question, if you want to take up to you.
Sure. So, that's right. That since last 3-4 years have been pretty challenging for the economy. So some of the sectors had come under stress, and corporate profitability had kind of got concentrated in certain more companies. But now that in the last few quarters we have seen a very strong, broad-based economic recovery, where sectors like metals, infrastructure, industrials have started doing well, apart from other sectors. So you are now going to see actually much broad basing of profit pools that is emerging. One. Secondly, current profits don't tell you about future profits or cash flows. What really matters is the sustainability of the current cash flows. And while we will obviously have some of the stocks that you talked about, I'll just give example. One of the most profitable sector in the country is IT services. Among the largest 5 companies in the sector, right, which is like 80% of the industry profits, we only own one of them. So it's like not like we are just owning, and in fact we have owned a number of small caps and mid caps in IT services, which were no-name companies 3-4 years ago, but today are considered, highly regarded. So you have to focus on the future winners. Some of the current winners will remain future winners. There's no doubt about that.
Right.
But you always have to focus on the future. And what Ayush had talked, some of the current companies that are going public, right, will emerge as the future winners. For example, you had seen some IPOs in tech companies, right, consumer tech also, even before Zomato. Those stocks also had done exceedingly well even after the IPO. So many of these companies, you always focus on the future, not on the past. The profits reflect the past. What do you have to focus on? Where the future, cash flows like, and some of these current companies will remain great companies in the future, but then a new set of companies will emerge, and that happens, by the way, every decade. For example, let me just give a name, right? Bajaj Finance 10 years ago was an unknown company. Today is one of the most defining company in financial services. So that happens all the time in all markets. And you'll be surprised 10 years later in 2030, there'll be a top 10 company that we didn't think too much about today.
Right. No, point taken. So sorry, we'll just take this one more question from Rohit Santalia. He asks, your view on hitting the 5 trillion economy. I know you guys don't like to talk too much about macro, but I'm sure that is one macro number that you guys also will be keenly tracking, because as we go to that phase, a lot of businesses, a lot of people will make huge kind of gains in the market and in their businesses. So I mean, if you're playing that theme, how are you doing it?
See, so Sankalp, see, getting to 5 trillion is just a number, right?
Right.
It can happen 1 year, 2 year late, ahead or late, right? What really matters is, are the integrants for a good economic growth coming into place into the economy? And when that you think about that, India had seen a number of distortions in the last 3-4 years, from demon to GST implementation to the NBFC crisis to the pandemic. And now we've seen the government very strongly focused on the reforms. The fact that in Feb, the government announced privatization of state-owned banks and insurance companies. By the way, that's the first happened for the first time in 74 years. The government banks are the holy cows, right? For the government, nobody has the political will to touch them. Now they're even willing to do that. So there is a will on the government side to constantly implement reforms. It has happened in mining sector, it's happening in labor sector. They've tried in agriculture, but it's currently on hold. But and a lot of taxation reforms have happened, including the recently the retrospective amendment of taxes. It's a very big deal. People don't realize from a global investor perspective, and it's politically not easy to do these things.
India was called a tax terror.
Yes, so we are trying to change that badge, right? If not, at least not terror, no longer, right? Number two, there have been strong positive momentum on the pro-growth policies. The PLI scheme looks like has already got early success in mobile phones and pharma. This has been announced and it's being expanded to a number of sectors. As of now, it looks like a scheme that has huge global and Indian interest to participate and build India as a manufacturing hub. And number three, there is a global tailwind in India's favor. There was anti-China sentiment only in US before the pandemic. Now this anti-China sentiment has now spread globally in Europe, in Africa, in India, Japan, Australia, Malaysia, other parts of Asia. To diversify the supply chains outside of China, what is called the China 1+ supply chain.
Right.
India has the potential to become one of the anchor countries, particularly with the PLI scheme coming in. So I would say the next few years, it's a game to lose if we don't grow fast enough.
Right. Thank you. So, any closing note to investors and participants on the call before we, wind up today?
So I would say that, fundamentally, in a country like India, where there is going to be double-digit longer-term earnings growth, markets will constantly hit highs. Volatility is a nature of the asset class in equities. The important thing is stay true to your asset allocation into equities. There are going to be once in a while potholes, which we are all used to in India in the markets. At the same time, at White Oak, we are very focused on delivering alpha, best-in-class alpha, and we have delivered, and we're confident of trying our best to continue to deliver the performance.
Right. Wish you all the best in your endeavor, and I hope you make lots of money for investors. With that, we conclude today's call. We wish a very happy Ganesh Chaturthi to all our participants in advance. We hope to see you very, very soon again. I have left my number and email ID on the chat today. So if you have any questions unanswered or just want to discuss any investment, please do hit us up. Any stocks discussed on this call was not intended to be an advice. Let us give the disclaimer loud and clear again. It's only for educational purpose. Thank you, Ramesh. Thank you, Ayush.
Thank you, Sankalp, and thank you for all the participants for joining the call.
Thank you.
Thank you. Have a nice day.
Thank you.